Kia ora. Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Frances Cook. I am the investments editor for BusinessDesk. For those of you who are new to Shared Lunch, we do these every Thursday at lunchtime. Each week, we alternate between an interview with a company leader and an industry deep dive. Now, we do have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch100, you'll get $100 off an annual subscription to BusinessDesk, which is usually $249, including GST. The offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. Do get amongst that. Now, before we get started, here's some important information. Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording. Now, just a quick reminder, if you have any questions for our guests today, you can submit them, and please do, through the Ask a Question button down below. Don't leave the questions in the discussion area, as they are likely to get missed amongst all of your other wonderful comments. Please do be kind and respectful towards our guest and your fellow viewers. Otherwise, we will have to unfortunately take steps to remove you from the webinar. Now, today we're joined by Philip Ascroft. He's a senior associate at Chapman Tripp. Now, Philip has acted on numerous capital raisings, including the very recent announcement about New Zealand King Salmon, as well as for eRoad, Kathmandu, Vista, Sky TV, and many more. Philip has also acted on the two NZX main board IPOs in 2021 for My Food Bag and Winton Land. So, welcome, Philip.
Hi, Francis. Thanks for the introduction. Hi to everyone in the chat watching along.
Thank you so much for coming on. Now, just before we get going, a note that we are talking about rights offers in general, although we will, of course, also be talking in part about things like the Air New Zealand capital raise. But if you have any specific questions about the rights allocation and your Sharesies portfolio, please do reach out to the investor care team at Sharesies. They can take a look at your account, help you out. You can get in touch with them by emailing help@sharesies.co.nz. Okay, so let's jump into it, Philip. Let's start at the very beginning. What even is a rights offer?
So, a rights offer at its most simple is an offer to all existing shareholders in a company to allow them to subscribe for additional shares in that company. And the key feature that distinguishes a rights offer from other forms of offers that can be made to people is that it's made on a pro rata basis, which means that if you're a shareholder and you choose to participate in the offer, you'll maintain at the end of that offer the exact same percentage holding you had in the company at the start, which is a difference from some of the other capital raising structures.
Yeah, exactly. Yeah. When it comes to these rights offers versus other capital raises, there are numbers of different ways that you can raise money as a company, right? So, what are the key differences here?
I think there's a couple of key differences really, and they're sort of I class it as practical and almost moral differences. So starting with the moral difference, the rights offer is broadly seen as the fairest form of capital raising, and the reason is that it gives every shareholder the same opportunity to participate in proportion to their current holding. So if they are able to participate, it means, and they choose to participate, they'll maintain that same percentage holding. Other forms of capital raising that are quite common are a placement or a placement in a share purchase plan. So with a placement, the company can choose which of its either existing shareholders or new investors issued shares under that placement. And with a share purchase plan, existing shareholders are given the opportunity to apply for up to $15,000 of shares under the NZX listing rules. That limit can be increased by an issuer using some of its placement capacity. But what that means is for people who hold quite large holdings, they might not be able to maintain their pro rata holding if they're only applying for $15,000 of shares. And so for that reason, having a rights offer, everyone has the opportunity to participate in accordance with their current shareholding. So that's why, from a sort of a moral perspective and treating all shareholders the same, it's seen as the fairest way of doing it. And when I say turning to the practical side, what I mean by that is under the NZX listing rules, they recognise that a placement can be perhaps unfair, or doesn't give all shareholders that same opportunity to participate. So it is limited to 15% of an aggregate over a 12-month period. It's limited to 15% of the company's shares on issue. So what that means is if someone's raising money, um, they may need to raise more than 15% of their share capital in a single hit. And so that would mean that a rights offer is the only practical way to do that, unless they go and get shareholder approval. And I think what sort of frames that up a little bit as well is companies are broadly raising capital for one or two reasons, and it's a little bit simplistic, but there's sort of the good reason and the bad reason. Is a really simplistic way of looking at it. A bit more nuanced is you say, okay, companies are raising money because they've got growth opportunities, they've got a great acquisition they're making, or maybe they have bought something and then they're looking at reducing their debt down after buying it, or they want to build a war chest to be able to go out and make those future acquisitions. That's kind of the good news story. And so what dictates the structure and size of a capital raising for those sorts of um, more planned, perhaps, capital raisings, it'll be driven by timing and the size of the check they need to write. For companies where it's perhaps not such a good news story, they have suffered the impacts of COVID, trading hasn't been good, um, where they're running, they're starting to run low on money, or they're worried they're going to run low on money, or they're coming up against banking covenants and coming under pressure to repay debt. That's sort of perhaps a less good example, or a less good scenario for the company to be in. And again, in that scenario, they may not have a choice. They may say, actually, we need to raise a lot of money, and the only way to do that is a rights offer, because a placement, the capacity is just not going to be there to fund it. Um,
Mm.
so those are some of the considerations really for, if a rights offer is, it's both a practical and a moral choice, I think, for companies when they're looking at doing a rights offer.
Interesting. And another word that has been coming up a lot is renounceable. What does it mean to make a rights offer renounceable? Why would you do it?
Yeah, so the reason to make an offer renounceable is what stepping back, what renounceable means in this context is just that the right to subscribe for shares is tradable. And so if you think about it, and we can use Air New Zealand as an example, where shareholders were given the right to subscribe for 2 shares for every 1 share they hold. And I hope I've got that right. So that right to subscribe for the shares, they can transfer that to someone else. And there's another layer of detail there of, you can have something which is renounceable and have the rights quoted on the NZX, which is what Air New Zealand's done, which means in the same way that someone can go and buy and sell shares on the NZX, they can go and buy and sell the right to subscribe for additional shares. If you buy that right, you still have to pay the offer price, the issue price for the share, but you've purchased that right. And the reason you do that is typically for a rights offer, it's priced at a discount to the prevailing market price, and also to the theoretical X rights price. And because it's priced at a discount, the right to subscribe for that additional share may be of value to people who see value in the company at a level that's less than the current market price.
Mm.
So if something's trading at $1, picking just a random example, yeah, something's trading at $1 and people are given the right to subscribe for shares at 50 cents in that company, someone might say, actually, and I think the company's valued at 80 cents. They go, okay, well, when it's trading at $1, I don't want to buy it. but if I've got a right to subscribe for shares at 50 cents, I'm happy to pay 25 cents to get that right. And so they've paid 75 cents for something that they think is worth 80 cents. So they're happy. And what making it renounceable means for the shareholders is that it gives them an option, or more of an option for what they do. If the offer is non-renounceable, the choice is pretty simple for shareholders. They either participate or they don't. If it's renounceable, they do have an option of they can participate in full or in part, and need to pay money out of their pocket to subscribe for the shares, or they can choose to sell some or all of their rights. And again, depending on the pricing and the market's view on whether the company is an attractive investment, that will dictate whether there's any value in those rights, that whether they'll actually be able to find a buyer for them. Um, and even when it's renounceable, they can choose not to do anything with their rights. So if it is renounceable and there's it's at a big discount and people want to buy into the company, people can sell their rights and get a bit of money back, even if they don't participate. And so from a corporate finance and a theory perspective, existing shareholders should pretty much be indifferent as to the price, in theory, as to the pricing, um, and the discount that's applied. And part of that is where it's renounceable or tradable is that if it's that they may be able to achieve some value for their rights, and the discount and the pricing doesn't necessarily affect the size of a check they have to write, because it's always in proportion to the capital, to the size of the capital raise.
Mm. Yeah, it's we'll come back to the pricing a bit because I think that has the possibility of confusing people a lot. The pricing can get a little complex, I feel, for people who
Yeah,
haven't maybe dealt with this before. But I'd love to go back to, you mentioned Air New Zealand. That's a really big one. We had New Zealand King Salmon yesterday as well.
yeah,
And it does strike me a little bit where you mentioned that there are kind of two main reasons why you might do a rights offer, where you've got expansion and growth plans. That really seems like the Air New Zealand sort of plan, where they're looking to get back and get out there after COVID. And then, of course, there is the possibility that you've been hammered a little bit by forces and you're needing to raise some money to get around it. Well, New Zealand King Salmon has had issues with fish mortality and getting some resource consenting for things that they want to get through. Um, that does seem like two sort of polar opposite examples of reasons to do a rights raise. I mean, when you look
yeah.
at these two big offers at the moment, what do you see as the differences between them?
Yeah, and I think in people can form their own view on it. I think Air New Zealand obviously does have growth plans, and they've laid out a strategy for growing a company and coming out of COVID. And I think there's quite a good, some graphs they've got for their forecasts of it going up. Um, from a bit of a dip during COVID. I mean, I think you'd almost arguably say that it's still in this balance sheet recovery and recapitalization type structure, because they do have quite a bit of there's a bit of background debt, which was in there, which they're using some of the proceeds to pay out. So they're probably a bit closer. I think like a really good example of showing the two different scenarios of quite black and white is Kathmandu. So in 2019, they bought Rip Curl, which was quite a big acquisition for them, and sort of brought together two iconic brands. And so to do that, they borrowed money to fund part of it. The banks only are going to lend so much, so they also raised some money at the time. So they did what's referred to as an REO offer, so it's an accelerated form of offer, which we can probably pick up later on some of the technicalities on that. But so they did a big rights issue to help pay for that acquisition of Rip Curl, and that was definitely it's a great growth story. We're bringing together these two iconic brands. We've got great plans for the future. This is 2019. COVID hits 2020. And we were acting on both of these, so we sort of saw it up close. But we were, it's like, okay, we're in lockdown. Kathmandu and Rip Curl, stores worldwide, presence worldwide. Lots of jurisdictions. Don't know what's happening there or what's going to happen. Every store in New Zealand shut. And they're like, okay, we actually need to raise money now to stay in business and to keep all these jobs and keep people employed and make it through. So they did a large what's referred to as an NREO, which is a non-renounceable form of offer, and the pricing difference is pretty significant between them. From memory, I think it was $3 in 2019, and then I think 55 cents somewhere around there in 2020. So
Wow.
it's kind of night and day. So that's a really good example of the contrast between a rights offer where you're looking at making sort of expansion and recapitalization. It is worth saying, like with Air New Zealand and King Salmon and any other investment that people are looking at, that just because people companies had issues with whatever's caused the issues, more fish mortality or COVID-19 or things like that, it doesn't mean if it's being issuing shares at a big discount, doesn't mean that it's not a good investment opportunity. People should obviously set their own investment advice, but just because bad things have happened to a company doesn't mean that it's going to be a bad investment, because the pricing for these things is set based on there's market feedback that goes into it, and there's sort of there's a bit of a market assessment made. So the price should, in theory, reflect the future value of the company. So people, shouldn't necessarily view it as investing in something that's, they're raising money to repay bank debt means that it's a bad investment. You know, the price should reflect the risks involved.
Well, yeah, let's dive into that because that's a really, I mean, it's usually the key point for people, but it's
Yeah.
also, a really interesting one. There are a lot of sort of technical issues that come into play behind the scenes before the rights offer is even announced. So when they're thinking about things like how much to sell the rights for or how many to issue, how is all of that decided?
So the way that's decided is the company will typically have one of the investment banks involved, or one or more of the investment banks involved, to help as a sort of lead manager and potentially underwriting the offer. And so part of what those investment banks will do is they will assist with providing sort of recommendations for pricing for the board to consider and take into account. And that will be formed on take into account a number of factors. So the two main things which the company will consider when thinking about how to price the offer is sort of book value, theoretical value of the sort of okay, well, the earnings forecast for the next year, next 2 years, next 5 years, however far out you want to go, take the earnings forecast, apply a multiple based on what it's currently trading at or based on comparable industry peers, and you can go, okay, well, based on that, the value of the company should be this much. You can use that to work out if the value of the company should be this much, and we're raising this amount of money. You can use that to sort of to back solve what sort of a per share valuation the company should, in theory, be worth, and what sort of earnings multiple that implies. So you can sort of, using comparable uh, industry comparable figures, you can try and work out, okay, well, in theory, what should this be worth? Obviously, with the price of the shares on the NZX or ASX or wherever else you're trading your shares, it's a market price though. And so then the second aspect that's relevant is that there is a bit of usually a process of soft sounding, of going out to some of those existing large shareholders. Um, it's pretty common, people go out under confidentiality arrangements, strict confidentiality arrangements ahead of the offer launching to talk to people and try and get some feedback on what price do people see value at for the shares, and what sort of price are they willing to pay, and that helps inform what a price is to set that's going to be attractive and ensure the success of the offer. Because quite often with a rights offer as well, given in that typically if people are doing a rights offer rather than a placement and a share purchase plan, it's pretty common for rights offers to be underwritten, which means that there's an investment bank standing in the background too, who's agreed to subscribe for any of the shares which are not taken up by taken up by shareholders. So it provides the company with certainty that it will receive the funds, the headline amount of the offer. And that's particularly important if you are making an acquisition. Let's say, if you're going out to buy a company, you need to know on the settlement date, just like if you're buying a house, you need to know you're going to have money there. And so having it underwritten provides you with certainty as a company that you're going to have the money there. Similarly, if you're raising money to repay the bank, you need to know, and the bank will want to know that no matter even if your shareholders choose to support the offer or not, you're going to receive the funds that you're expecting through the offer to repay it. For something like a placement and a share purchase plan, sometimes you'll see the placement will be underwritten, so they'll go, okay, we need to get this much in, and then we might have a share purchase plan and sort of be, if we get extra amount, great. If not, we're not so worried. But yeah, the pricing is set at a way that is going to attract the support of people who they need to get the money raised.
Interesting. So it sounds like a little bit of art and a little bit of science there.
Yeah,
When you look at something like King Salmon, there was a whopping 83% discount on the share offer versus the existing price. And of course, once it was announced, the existing share prices took quite the tumble. Is something like that, is the price of the existing shares and how it will affect that, is that factored in behind the scenes or not really?
yeah, it is, and I guess the way it's factored, what's factored in with it is that the price at which you're raising money for, particularly for rights offer, um, it's factored in a couple of ways. So when you talk about a discount or sort of an 80%, 86%, I think it is, discount to the last close, that's, it's kind of relevant. But what's sort of more relevant with a rights offer is the discount to something called TERP, which is the theoretical X rights price. And what that reflects is, say it's a one offer, to make the maths a bit simpler. If you've got one existing share and and there's another new share being issued under the offer, that means if that one existing share before the offer is only sort of represents half as much ownership in the company as it did before. And so the theoretical X rights price takes account of that and weights the price of the shares, taking into account the number of new shares to be issued and the price at which they are to be issued, and the number of existing shares and the price they're worth. And so for King Salmon, it's sort of that closes up because they're issuing a lot of shares given the amount of money they need to raise and the price at which they're raising it. Um, that narrows that gap down to sort of like a 50% discount to which is still relatively high, but it's coming down a bit. But I think, and the trading of existing shares it is taken into account, and I think one of the things, and it's probably useful background for shareholders and Sharesies members to understand with these offers, is from a legal perspective, for people to make a rights offer, they need to issue something called a cleansing notice or a same class offer notice. And so that's a sort of a one-page notice which is issued to NZX, which says confirms the company's in compliance with its continuous disclosure obligations. So they've released all information which is material to NZX, which is information they expect would have a material effect on the price if it was known. And under the sort of the NZX continuous disclosure rules, companies can legitimately withhold from disclosure material information for several reasons, most commonly because it's confidential and relates to an incomplete proposal or negotiation. So if a company's negotiating a big acquisition, so long as that remains confidential, they don't actually have to disclose that to NZX until that negotiation is complete and they've actually signed the agreement. Similarly, things like internal management information, again, so long as it's kept confidential, that doesn't necessarily have to be released to NZX. And so what that means is that when people announce these offers, they go through a process before announcing it to try and work out and confirm whether there is any material or additional information that needs to be announced to NZX. So it's quite common for the documents that are actually released to NZX, there'll be this sort of one-page cleansing notice which says, hey, yeah, we're in compliance with continuous disclosure, we've released everything to NZX. But it'll also usually be an investor presentation released, which is a 30 to 40 page document which sets out, usually it sets out, update on trading, sometimes it's combined with the results for the period. So King Salmon included their FY22 results in the investor presentation. And so that's the kind of thing which actually, in and of itself, you'd expect might have an impact on the existing share price, even if there was no rights offer or capital raising announced. So it's sort of the capital raising, though, is used and they need to crystallize this disclosure obligation to get that additional information into the market. So I think it's important to consider that the trading will reflect both the fact they're raising money, and you'd expect as well that depending on the size of the offer, if it's a really large offer, you're expecting a lot of new shares to come in. That means that the offer price, sorry, the market price, probably will trade and trend towards that offer price during the period, because if people know they're going to be able to buy shares at, I think, 50 cents, let's say, and it's trading at $1, why would you pay $1 on the market if you think you can, if you're going to subscribe to them at 50 cents?
Mm. Okay, so we've had these two big ones announced so far, but there's been a few rumblings that this year could be a big one for capital raises on the market in general. So if are announced, or if people are thinking about whether they want to jump in on these current ones, what are things to think about when these are announced, and if you're thinking about participating in a rights offer?
Yeah, I think there's probably three things people are really going to want to do. And I think the first one, and this sounds really simple, but I think it's important for people to do, is to get their hand, look at the documents that have been released to the market and look at the timetable. I'd say is actually the first thing to do. So for a rights offer, you typically have to give at least 5 days notice before what's referred to as the X date, but say sort of a record date, and that's the date at which it determines who's entitled to participate in that offer. And so that means there's a period of time where people can buy and sell the shares, where the right to participate in the offer is attached to those shares. So knowing how long they have to decide on that is important. Equally, knowing when the offer opens is important, and perhaps most importantly, if they want to participate, knowing when the offer closes is important. But the documents will have in them a timetable which will set out all these dates. So people having a look, first thing, like look at the documents, work out what the dates are, because that will drive when people need to make decisions by. Because shareholders will have some decisions that they need to make, and doing nothing is a decision. It's effectively a choice. So if you ignore it, you're sort of making a decision not to participate. I think the second thing people should do is look at, like I said, there'll usually be an investor present, or should be an investor presentation or something like that released. Have a read through that. It should set out some really good information about the company, why it's raising the money, what's been happening with the company recently. It'll also have some of the risks which people need to be aware of about investing in the company. So people should read and consider those, because there's always a risk involved in these things. There's no guarantees. There'll also be an offer document released which will set out the sort of terms and conditions. That's usually the recent trend has been for those sort of offer document to be fairly vanilla, and there's not too much in there. It's like largely a terms and conditions document. So the investor presentation will be like the real key corporate commercial information will be included. The offer documents of terms and conditions. And then I think the third thing is people should take advice if they're not sure what to do. Seek advice from, like, there's I know Sharesies has got some great resources and some great explainers about rights offers. Often there's media articles written which people shouldn't take financial advice from the media, but might help point out some of the things they need to be aware of. There's, I think the Sharesies Share Club Facebook page of, those sorts of things where, like, if people have queries and they're not sure what to do, yeah, they should seek advice, obviously, ideally from a financial advisor, but yeah, try and work out what to do with them, because doing
Yeah.
nothing's a choice, and they may, depending on the offer structure, doing nothing with it may be leaving some value on the table for shareholders.
Yeah, and just a note to our audience as well. We are getting to the end of my questions. So if you have questions, jump on that ask a question button, get it in there, and also upvote the questions that you are interested in me putting to Philip here, so that I know which ones are most interesting to you. Don't forget, of course, Philip can only really talk to us about rights offers. He can't really explain what's happening with your share portfolio itself. That's a question for Sharesies. And you can hit up the team with that email that we dropped into the chat earlier. But do drop in those questions. I want to make sure we get them answered for you. We'll have to be quite quick on this last one from me, otherwise, I will hog all the time. But once all of this stuff starts coming to a close, we have something called a shortfall book build, which is a little jargony. In plain English, what's that and how does it work?
Yeah, so a shortfall book build, and that's probably the um, can be used in a couple of different offer structures. But so a shortfall book build is offers closed. Some shareholders haven't taken up their rights, or they may have been ineligible to do so. For example, if they're in an offshore jurisdiction where that offer wasn't made, um, the company and its investment bank helping run the process will take all of those rights which weren't taken up, and they'll offer them through a single book build to people to purchase. And so what a book build is effectively it's an auction. So they'll say, okay, we have the shortfall of 1 million rights. We'll take bids for those rights, and typically, the minimum bid will be the offer price. So if the offer price is $1, people can bid for shares or rights, at $1, and then they'll also usually take bids, can take bids above that. So they might say $1.02, $1.04, $1.06, sort of in a range. And the book build would typically be priced based on the bids received, the level which is going to clear, say we've got $1 million a million rights shortfall in the book build, what price can we allocate all of those million rights out to people who have bid for them? So that might be at the offer price, or it might be slightly higher. It might be $1.05, and the offer price was $1. In that case, that difference between what the shortfall book build closes at and what the offer price was, that's typically paid out to those holders who didn't participate. So what that means is if you're a shareholder and you don't participate, if there's enough demand for those rights, if there are enough people who do want to take up those rights through a book build, you may still get some value for your rights. And that's equivalent to where an offer is renounceable, the rights are quoted on the market, people can buy and sell them on NZX. It's the same sort of principle of having a shortfall book build means that if there's value attaching to those rights, someone might be willing to pay for it, and the shareholders, even though they don't participate or they're unable to participate, still receive some value from the offer.
Interesting stuff. Okay, let's jump into audience questions here.
Great.
So, when a rights offer, and we have to start with this one from Tim. So, thank you for everyone who upvoted it. It's great. When a rights offer is executed slash activated by a company, is it generally the case that the existing shareholders are diluted? And as a result, do you think this is a negative for those investors? Most likely, it's retail investors who couldn't afford to jump in.
Yeah, so I think that, I mean, from a mechanical perspective, yes, once there is a rights offer, existing shareholders will have their holdings diluted if they don't participate. Of course, that's the trade-off, and so they do have the opportunity to participate. And I totally hear where you're coming from, but it's can be difficult for retail shareholders who, if they're not professional investors, they're not necessarily going to have the spare money sort of sitting around to be able to participate in these offers at relatively short notice. Often the offer period can be relatively short. It's sort of a usually it's a 5-day notice of the offer coming up, and then the offer itself will be open for usually a minimum of 7 days. But appreciate that may not be enough time for people to get money together. What I would say is that companies are aware of this, and people do try and design offer structures that have things like a shortfall book build, or trading of rights, or where possible, to provide an opportunity for shareholders who, yes, they might be diluted if they don't participate, but if there's enough demand, they'll still receive some value for their rights. So, if there's a shortfall book build and they can achieve a premium, sure, people are diluted, but they sort of, hopefully can receive some compensation for that dilution.
Mm. And this is a great one from Colin. If the capital raise doesn't meet its target, does it get cancelled?
That would depend on the terms of the offer. So there's sort of be two different approaches there. One would be if you have a underwritten offer, whatever the take up is, it might be 60, 70, 80, might be 30% of people, whoever, whatever percentage of people take up their shares. What will then typically happen is there might be a shortfall book build at the end to try and clear that shortfall, to try and place it, get it put to people who want to take up the shares, or failing that, there might be the underwriters might agree to subscribe for those shares. Um, you can also have things like allowing existing retail shareholders. So this is the case for New Zealand King Salmon. If you're an existing retail shareholder and you take up all of your rights, you can apply for up to an 100 additional 100% of your rights. So you can double your entitlement effectively, and apply for additional rights to try and clear that shortfall to keep it to a minimum. Um, if it's a non-underwritten rights offer, then it would usually be the company will get whatever it will get. It's not common for a rights issue to have a sort of a minimum amount to be raised. It's usually, the company will sort of take whatever it can take, if it's not underwritten, and if it is underwritten, the underwriters will cover the shortfall.
Hmm. Okay. And I really like this one using the Air New Zealand one as an example here. After the X Rights Day, Air New Zealand shares had a reference price of 0.795. Does that mean that theoretically the price should not go below that once the new shares are issued after exercising rights?
Uh, no, no, I wouldn't say that. And I think that's for a couple of reasons. So that theoretical price is calculated. That was simply that theoretical reference price was calculated by taking the market price at close of trading before the X date, the price under the offer, and blending them, like I was saying, with that theoretical X rights price. So that's how price was calculated. It's a theoretical calculation. People can form their own views as to people can and will form their own views as to whether Air New Zealand shares are worth more or less than that. So there's no guarantee that the price won't drop below the theoretical reference price, because it's theoretical. The market will decide what those are worth, um, and that's both because future of things, things will happen, right? Like no one predicted COVID, and so that changed things. And secondly, that the rights price, offer price, is set, based on feedback and market soundings and that kind of thing. But no one who's to say it's right. Like it's sort of a theoretical price only. So I wouldn't want to guarantee, wouldn't want to assume that it won't go below that theoretical price, reference price.
Yes, yes. There's a reason it's the reference price and not the actual price.
Correct.
Um, Last question here, and another great one. Thank you so much, everyone, for putting in these great questions and upvoting them. Can the funds raised not be used for the originally disclosed intentions? If that happened, what happens next? Do the funds get refunded?
Yeah, so the, the short answer is the funds can, once the funds have been raised by the company has the money, can do whatever it wants with them. Um, the slightly more nuanced answer is, yeah, the company would typically go out. in the investor presentation and the documents that are released to shareholders, it will say what the purposes of the offer is and what they're using it for. So in some cases, that's going to be really clear. Like say, Chapman Tripp buying Rip Curl is a really classic example. They've said, okay, we're raising this money to pay for Rip Curl. We've signed a contract to buy it. This is the settlement date. They raise the money. They're going to use it for that, right? Like there's nothing else they're going to use it for. Where it's a bit more grey, they might say, oh, we're raising the money to repay debt and position our balance sheet for future growth opportunities or something. It's like that could be they're leaving themselves a bit of wiggle room as to what they're actually going to use it for. Um, it's important to note, though, that the documents released to shareholders do have to be accurate. There are laws against them being misleading or deceptive. So a company needs to be careful that if it's saying one thing in the documents that are going out to shareholders as to how it's using that money, even if there's no contract or rule in place which is going to force them to do it, they do have to stick to what they've said to shareholders, to avoid those documents being misleading, even if there's no actual rule in place to stop them from using it for something else.
Fascinating stuff. I think this is it's one of those issues. And obviously, as you've mentioned a few times, you can sometimes have to look at the terms and conditions for each individual offer. But the
Yeah.
general issue itself is just a really fascinating one. So thanks for tuning in, everyone, to work through this with us. Big thanks to you, Philip, for joining us. Really appreciate your time and your insights. Please do also check out Sharesies' financial news podcast recap. It's about 10 minutes long. It's published 4 times a week on Spotify, Apple Podcasts, and Apple Podcasts. Next week, Shared Lunch will be back with Andrew Peskett, the CEO of Radius Care. There's a link to register for that one in the chat right now. Come along, let's have another really interesting conversation. Until then, enjoy the rest of your week. Stay safe.